Financial Statements Part 2. 2. Income Statement, Profit and Loss Statement. An income statement shows the company's revenues and expenses during a particular period. It shows how profitable and sustainable a company is. Key components of an income statement include revenue, cost of goods sold, gross profit, operating expenses, operating income, other income and expenses, for example interest, taxes, net income. Revenue or sales. Revenue or sales are received after the selling of products or services of the company. This is the first section of the income statement. There are two types of revenue, which are operating and non-operating expenses. Expenses. Expenses are costs that a business has to pay to generate revenue. There are also two types of expenses, operating and non-operating. 3. Cash flow statement. It reports the cash generated and used during a specific period. It allows investors and shareholders to see where the money is coming and going. Key components of a cash flow statement are operating activities. This is cash flowing from the core business operations, for example receipts from sales, payments to suppliers, etc. Investing activities. This is cash flow from the purchase and sale of long-term assets and investments, for example purchase of equipment, sale of securities, etc. Financing activities. This is cash flow from transactions with shareholders and creditors, for example issuing shares, borrowing, and repaying loans. 4. Statement of equity. It shows changes in the ownership interest of shareholders over a period. Key components include share capital, retained earnings, dividends paid, adjustments due to changes in accounting policies or corrections of errors, other comprehensive income. Financial statements are prepared following standardized accounting principles, such as International Financial Reporting Standards, IFRS, or Generally Accepted Accounting Principles, GAAP. These principles ensure consistency and comparability across different organizations.